Hello everybody and welcome to today's webinar, Opportunities in Global Equities. We're happy that so many of you have taken the time out to hear from us on this particularly interesting topic, and we'll be getting started in just a few minutes as we wait for a few more people to log in. Thank you very much. Hello everybody and welcome to today's webinar, Opportunities in Global Equities. We'll just get started straight away by letting you all know that this information is general information only. It does not constitute personal advice. If you do have any interest in any of the funds we are talking about today, please do review the product disclosure statement and talk to a financial advisor. From a housekeeping perspective, for those of you who haven't been to a webinar that BetaShares has put on before, please be advised that a recording of the session will be sent to all registered attendees of this webinar. Please feel free to ask questions throughout by typing into your widget. We will endeavour to answer those questions either during or at the very end of the webinar. Today's presenter is Peter Harper. Peter is our co-head of sales here at BetaShares, responsible for leading sales strategy and execution across all client segments. He's formerly been with the Macquarie Bank, UBS and ABN AMRO, and he also heads up our capital markets activities at BetaShares. Today, Peter will be talking about several things, including why one could consider investing in global equities in the first place, and providing reasons why that should be, and then talking about 4 opportunities, or in fact 3 opportunities to invest in global equities, which we will go through. But before we start, we always like to do things that are a little bit interactive. And so just a question for attendees, if you can please respond on screen there. What percentage of your investment portfolio is in global equity exposure? So of your total 100% exposure, what percentage is in global equities? Just wait for people to respond to that. And this is what we had received back from you. We received back that the majority are between 0 and 25%, around about 30% between 25 and 50. Quite a few of you with a 10%, a very high proportion there, 50 to 75, and 2% who actually have almost all of their portfolio in global equities. And then, relatedly, the question we ask is, how do you expect that to change? So looking at the next 12 months, do you expect that to increase, decrease, or stay the same? Just tallying the results now. And I will share those now. This is definitely a bit more clear-cut. Certainly essentially nobody suggesting they will decrease their exposure to international equities. And more than 50% saying they'll increase exposure to global equities, and a pretty big minority there also in terms of staying the same. Now, this is very similar to the results we saw in a financial advisor session we did earlier in the day. So it certainly feels as though global equities are either on the rise or very much on people's minds. So this may well be a timely session. Finally, before I hand over to Peter, just to let you know there are handouts in this particular widget you can see there, and that describes some of the products that we are talking about today. With that, I will hand over to Peter Harper.
Excellent. Thank you very much, Alan. And most importantly, thank you very much to everyone for joining us today. We appreciate you making the time to spend about 30 minutes with us, and we value that greatly. So we'll just kick off now and look at why consider global equities. There are a few key things that jump out at us in this regard. If you look at the Australian economy, it's very heavily tilted towards resources and financials, particularly the banks. Now, resources may have come off their cyclical lows, but it seems pretty clear that the mining boom has been and gone. And therefore, that is a more challenged part of the market than it has been historically. Then you look at the banking sector and financial sector, which are another very large part of the Australian market. And certainly credit growth seems fairly constrained, which is a negative for the banks. We've seen a lot of scrutiny of the banks and the ways they earn their margins throughout the Royal Commission, and that could lead to more stringent requirements on those banks that could impact potentially their profitability going forward. So the two key historical drivers of the Australian economy look, more challenged than they did, shall we say. Another factor is that if you look at Australian businesses, in the old days, they probably operated in this economy in a fairly much as if we were a separate island and didn't have to worry as much about offshore competition. But the more global the economy becomes, the more under threat Australian businesses are from large global competitors who want to add Australia as a marketplace for their business. An example of that, I suppose, is thinking of something like Amazon, which is starting to enter the Australian market more aggressively. And does that pose a risk to Australian retailers, for example? And the last thing is, historically, it's been difficult to access international equities, but it's actually now becoming much easier with investments such as ETFs providing a very simple, low cost and diversified exposure to global equities in one trade on the ASX. So we think these are some of the reasons why investors should start to consider global equities. In terms of the opportunity globally, Australia accounts for only 2.3% of world share market categorisation. In other words, we're a drop in the ocean in terms of the opportunities available globally. We think it makes sense to at least consider how the other 97.7% of global opportunities might actually benefit your portfolios. To put this in a domestic context, I would argue that if you were only investing on the Australian Stock Exchange and you had access to only 2.3% of the market capitalisation of that exchange, it would be difficult to build a quality portfolio of Australian shares. In that sense, in the same sense, investing internationally is no different. If you limit yourself to a small part of the global market, you limit yourself to a small part of the opportunity set. We've discussed already how the Australian market is very overweight financials and resources, and you can see that in the right-hand column here covering the S&P ASX 200 with heavy weights towards the financials and materials sector. What that means is that there are large parts of the global opportunity set that aren't particularly well captured on the ASX. Think of a business like Amazon, which fits under a consumer discretionary exposure or sector. Consumer discretionary is only 4.8% of the ASX 200. By contrast, in the left-hand column, or the middle column, you can see the NASDAQ 100 index, where consumer discretionary makes up a much higher proportion of that exposure at about 22%. Similarly, information technology, companies like Microsoft, Google, Facebook, etc., make up about 60% of the NASDAQ index, but only 2.3% of the Australian index. So looking at Australia alone, with its concentration towards financials and resources, makes it difficult to get a portfolio that is broadly diversified from a sector point of view. However, if you were to consider blending an Aussie portfolio with something like the NASDAQ index, for example, you see that indexes like NASDAQ have no exposure to financials. So you're not doubling up on your big overweights in the Aussie market. No exposure to materials. Again, not doubling up on your big overweights in the Aussie market. And yet they provide large exposures to IT and consumer discretionary, those parts of the sector profile that are underweight in Australian markets. So these are some of the areas where offshore equities offer opportunity. So what we're talking about here is avoiding what's known as home country bias. We've got a little statement here. Home country bias is like fishing in a tiny pond when the whole ocean beckons. So what is home country bias? Well, home country bias is the tendency of investors, not just in Australia, but all over the world, to invest predominantly in locally listed companies. Why do they do this? It's understandable because they're investing in companies that they're more familiar with. That said, by only focusing on the companies you're more familiar with, you may miss out on other opportunities of portfolio diversification or other growth opportunities that exist outside of Australia. The appetite to invest offshore is growing for SMSFs, and we've seen SMSF investment in direct international shares jump by about 57% over the last year, with a big focus on technology and Chinese equities in particular. The beauty of ETFs is it allows investors to buy offshore equity exposure on the ASX in one trade, fully diversified at low cost, as simply as buying BHP or CBA. If we look at research of the Australian market, one of the key or the top 3 reasons that people invest in ETFs is for low cost, diversification, and access to specific overseas markets. So there certainly tends to be a high level of demand for exposure to offshore equities. And that flows through to what we're seeing in the ETF market as well. Thus far, year to date in Australia, going up to the 30th of September, we've seen about $2 billion flow into international equities ETFs on the Australian market. That is more than double the next biggest asset class for inflows of fixed income. So that probably paints the high-level consideration of why global equities. I now want to jump into some of the opportunities available in global equities. And there are 3 key international equity thematics that I'm going to investigate today. The first is investing for income. The second is investing in quality. And the third is investing in disruption. Let's look firstly at investing for income. And recently, BetaShares launched its Global Income Leaders ETF, ticker INCM, which is the 100 highest yielding global large and mid-cap corporations. You can probably see there many names that you're familiar with. Singtel, Ford, General Electric, Lazard, the big fund manager, Verizon, one of the big mobile businesses of the world. So as I mentioned, ticker for this exposure was INCM, and it's available at a competitive expense ratio of 45 basis points all in. This particular exposure does also have a little bit of a value to it as well, and in recent market turbulence we saw value do quite well relative to some of the growthier parts of the market. So how does the index select its stocks? Well, it starts with an eligible universe that includes developed market shares ex-Australia that are classified as either large or mid-cap. Now, I think it's important to highlight the fact that mid-cap shares are considered in this exposure as well. And the reason why is that we've seen a lot of talk of global trade wars and Donald Trump and China in particular in the press over the last few months. Now, one thing to consider is that mid-cap companies tend to have a higher level of revenue from their domestic markets as opposed to export markets, and therefore may be less sensitive to the impacts of global trade wars. So I think the ability to include both large and mid-cap exposure is a plus for this index methodology. The index then screens for stocks that have dividend sustainability factors. And those factors are a persistent dividend, a payout ratio that is within reason, profitability, the companies must be profitable, and a maximum volatility level. All of these factors, we think, can help guide towards sustainable dividends over the long run. Those companies are then weighted by yield, and we apply country and region weights in line with broad global benchmarks to ensure that we don't lose global diversification just by looking for higher income. What I have here is the chart of the income generated from INCM. And if we look at that, the current yield for INCM's index is 5.2% per annum. That said, as many of you may be aware, anytime you invest internationally, whether through direct shares or bonds or managed funds or ETFs, earnings generated offshore can be subject to withholdings tax by the government of the domicile in which you're investing. As a result of that, after subtracting withholdings tax, the actual yield to be paid through on INCM would have dropped from 5.2% to 4.5%. So that 4.5% number is probably more the one you should be considering after the deduction of withholdings tax. That stacks up very well against a broad MSCI World Index, which has a net of withholdings tax yield of just 2.3%. So very high levels of income relative to a broad MSCI World exposure. Also, a high level of income relative to the net of franking credits yield on Australian companies of 4.2%. So what this is saying is no longer is it the case necessarily that if you invest offshore for diversification and growth, you lose opportunities, you tend to lose income. Here there is an ability to add diversification and maintain still what we believe to be an attractive level of income. And not only is the income one of the attractive elements of INCM's exposure, but historically, INCM's index has outperformed the MSCI World Index going back to March 2007. I'm now going to move on to investing in quality. And just this week, we launched the BetaShares Global Quality Leaders ETF, ticker QLTY, available for an all-in fee of 35 basis points on the Aussie market, making it the cheapest quality exposure available in Australia. So what is quality about? When you boil it down, quality really comes down to high and sustainable return on equity. So a business that generates high and sustainable return on equity is broadly considered in the investment community to be a quality company. And what factors might indicate high and sustainable return on equity, or ROE, into the future? The first is the financial health of the business. So QLTY's index looks for businesses with low total debt to total capital ratios. So you don't want a business that's too indebted or carrying a large debt burden. You want a business that's profitable. and one that generates very high levels of cash flow in a very efficient manner with high profitability. And you want a business that's stable rather than one whose earnings are very cyclical and can jump up and down from market environment to market environment. You're looking for a business that has stability and low earnings variability through the cycle. So those three factors together have tended to historically indicate higher return on equities into the return on equity into the future. Why is that important? Well, this chart will show you. The grey line down the bottom is the chart of companies which had at one point a high return on equity but were not able to sustain that high ROE. And the red line shows companies that achieved and sustained consistently high return on equity. And you can see that the performance there really is chalk and cheese in favour of those businesses with greater quality metrics, higher sustainable return on equity. Here we look at the performance of Quality's QLTY's index relative to both the MSCI World Index and the MSCI World Quality Index. And you'll see that QLTY's index has outperformed the MSCI World Index by about 2.5% per annum, going back to around 2002. It's also outperformed the MSCI World Quality Index by about 1.2% per annum. So strong historical performance characteristics. But performance is not obviously the only consideration. QLTY's index has also historically displayed defensive characteristics during market declines. The blue shaded area here shows the maximum drawdown of the MSCI World Index through various periods. And we can see that throughout the GFC, MSCI World Index fell 42% at its worst peak to trough fall. The corresponding statistic for QLTY's index was 23%, which suggests that quality businesses may provide more defensive characteristics during a market decline. The third factor I wanted to look at today in terms of opportunities in global equities was investing in disruption. And there are two key exposures that I want to cover in that regard. The first is the BetaShares Global Robotics and Artificial Intelligence ETF, ticker RBTZ, and the second is the Asian Technology and Internet Retailing Tigers ETF, ticker Asia. What is driving the growth of robotics and AI? I can remember many times in my life reading articles that wrote with concern about how robots were going to do people out of jobs into the future. Well, here we are, and robots are entering our society. Does that mean we're all going to be without jobs in the future? I'm going to argue that it's actually the opposite. I'm going to argue that we actually need robots to step in and take the place of humans purely to be able to maintain production, maintain GDP and growth in our economies. And the reason why is this. The proportion of non-working age population to working age population is expected to double over the next couple of decades. So if we do nothing, it's likely there will not be enough workers to sustain all the productive processes that we require based purely on an aging population. Therefore, far from robots kicking people out of jobs, we actually need robots in the future to be able to maintain production and delivery of goods and services in the economy. The second factor is labour costs. When there is a scarcity of labour or a scarcity of any input to a process, generally that input gets valued more highly. And so there's a risk with a scarcity of labour that it could lead to high wage pressures and inflation in the economy. by incorporating robotics and AI, there's an ability to hopefully mitigate some of the wage pressure and inflationary pressure that could flow through in an environment where labour is scarce. Finally, let's talk about performance. The simple fact is, robots now are able to work in a manner that is often faster, more precise, with higher quality and less waste than what human production can do. So there's just an out-and-out efficiency benefit to employing robotics and artificial intelligence. For these reasons, we think there's an opportunity to consider an investment in global robotics and artificial intelligence via our BetaShares Global Robotics and AI ETF, ticker RBTZ, or as we like to call it, Robots. This is a very simple way to, in one trade on the ASX, get exposure to some of the largest companies involved in robotics and AI in the global market. So what's included in this index? Well, the beauty of it is it includes a broad spectrum of robotics and artificial intelligence. Of course, there's industrial robots. You've probably seen on TV images of robots making cars many, many times, and that's industrial robotics for you. But also non-industrial robotics, things of the nature of harvesting harvesters on a farm that are harvesting crops without a driver and actually drive themselves. Things like surgical robots, which are improving accuracy and making possible surgical procedures that haven't been able to be conducted by human hands alone. Autonomous vehicles and drones, and of course, artificial intelligence. Here are some of the major names included in this robotics index. I'll leave you to look up a broader list and read up on those names in your own time. I now want to touch finally on investing in disruption via the BetaShares Asian Technology Tigers ETF, ticker Asia. Asia is now home to 4 of the largest 10 global technology companies. You can see there Alibaba, Tencent, Samsung, and Taiwan Semiconductor. So to ignore Asian technology is to ignore a large part of the technology opportunity set. Additionally, there seems to be, based on projections, a huge potential for growth in online commerce within Asia. You can see that as of 2018, estimates are for about 13 billion of e-commerce spending. That's expected to rise to 88 billion by 2025, which is 7 years ahead in time. Also worth noting is that when we look at adoption of online shopping in China, it's running at about double the rate of adoption as online shopping in the United States. So the Asian population is taking to online shopping and internet retailing and technology in that space very quickly in terms of adoption. Internet usage in the United States sits at 90% of the population. If you go to China, that is only 50% of the population that is using the internet. So we believe that there is greater scope for internet usage and adoption, and therefore greater growth potential, one could argue, for Asian technology and internet businesses relative to their US peers. Additionally, Asian technology historically has provided a fair degree of diversification away from other global technology exposures. And this thematic is available on the ASX now under ticker Asia, ASIA, the BetaShares Asia Technology and Internet Retailing Tigers. Fee for this, 67 basis points. Now, I won't go through this in detail. I'll leave you to read through some of the major Asian tech and internet retailing tigers in your own time. But one I would just like to point out is that look at Alibaba. Alibaba is the world's largest retailer. Its online sales and profits have surpassed all US retailers combined since 2015. And that's including Walmart, Amazon, and eBay. That gives you some idea of the scale of this business and the potential opportunity from investing in these sorts of businesses. And that's where we'll leave it for today. Just some things to keep in mind. Obviously, there is investment risk when making any investment. Investment returns are uncertain and will be influenced by the fluctuations of the market as a whole and other risks such as sector concentration risk with technology ETF exposures. Investors should seek professional advice before investing. Past performance is not an indication of future performance, and you should read the relevant PDS for more information about risks. I would also strongly encourage you, if you're beginning your ETF journey or even partway along it, to consider looking at our new free online educational email course. That's available at betashares.com.au/ETF-basics-course. In that course, you'll find 6 step-by-step emails designed to give you all the facts as you start your investment journey in ETFs. There's also 4 exclusive ebooks covering the topics you can see there. And finally, an interactive ETF navigator that helps you navigate the ETF landscape and find the ETFs that best suit your investment goals. And of course, if you're not already signed up, please sign up for our blog or follow us on Twitter, LinkedIn, and Facebook. You can receive regular economic insights and portfolio construction commentary from our Chief Economist, David Bassanese, and blog insights from the broader BetaShares team. There's also a huge amount of content and investment and fund information available on our website, betashares.com.au.
Excellent, Peter. Well, we've got time for just a few questions before we wrap up, so we'll just address some of those. There was just a few questions that came around, I suppose, broadly tax as it relates to investing in international equities and I suppose international ETFs. So I suppose maybe it's worthwhile describing that, what that's about.
Okay, well look, I'm not a tax advisor and therefore can't comment on anyone's individual tax circumstances, but to make 2 broad comments regarding tax efficiency and international equity investments of any variety, I would say 2 things. Number 1, for those who aren't aware, international equities are not eligible for franking credits. So, if you're getting, off the top of my head, roughly 1.5% franking income from Australian equities, you would want to consider the fact that you wouldn't receive that for on your income out of an international equity exposure of any type. That said, international equities have demonstrated greater growth opportunity over the long run and therefore may still stack up very well and may be a great diversification tool. The other is the presence of withholdings tax, which I covered off earlier, and I think we're probably covered there.
I think just one important thing we should note about the BetaShares range of products is that the actual, often when you invest in international equities, particularly from the US, there's a need to sign or form which is known as a W8BEN form. Because our funds are Australian domiciled funds, or they're basically Australian funds, one does not require to do that, and we do that on behalf of all the investors. So in terms of the actual investment side of investing in these funds, there is no additional tax paperwork to deal with at all. Look, just a question that was asked about, and I'll try to flick back to the QLTY fund. The question was just asked about some of the names that are in that. So I suppose the best thing to do would be to just look at those names and maybe get a comment on some of those names, please.
Sure thing, Alan. So some of the companies that are contained in this index and which you might meet the index criteria for quality are businesses like Walt Disney & Co., Intel Corp, Johnson & Johnson, Roche, Apple, Unilever, Costco, Facebook, Visa. So they're all fairly well-known identifiable names to Australian investors, and probably names whose products and services you use on a regular basis.
Yes, I think that's right. Typically when we do the quality filters, we notice that there's some very, very large household names, and of course the top 10 are shown there. But if you were to go to the BetaShares website, you could download all 150 portfolio holdings on our website. So just a question about portfolio construction and weighting methodologies for 3 funds. So the question was asked, how are the funds put together for QLTY, RBTZ, and Asia? And that's a relatively dense question, but I don't know, Peter, if you wanted to just talk a little bit broadly about those 3 funds, how the portfolio is set up and the weighting methodology for those.
Yeah, so broadly speaking here, we're looking at modified market cap weighting. So they're weighted by market capitalization, i.e. the bigger companies get bigger weightings in the index, with some modifications to cap securities at certain levels to make sure that no 1 or 2 individual companies become too big a part of any of those indices, and in order to keep strong diversification characteristics across those exposures.
Yeah, great. And again, to get into that in a little bit more detail, I would encourage you, Christopher, to just go and have a look at our website, where you'll be able to find, first of all, the actual index methodology, but in a little bit more of a plain English way, some of our brochures and blogs do a pretty good job of describing how those portfolios are put together. It's quite an easy one here from David. Are Japanese companies allowed in the Quality Asia and RBTZ ETFs?
Okay, so, excuse me, for quality, the answer is yes. For RBTZ, the answer is yes, and in fact, Japan, being a leader in robotics, is the largest weighting in that exposure. For Asia, the exposure is actually Asia ex-Japan, so that does not include any Japanese businesses in Asia.
Okay, quite a few questions coming here. Some that were very easy to deal with. FX risk, are the funds hedged to the AUD? These 4 funds that we mentioned today, are they hedged?
All of these funds are unhedged. So if the Aussie dollar falls against the global currencies of those individual companies held, you would expect that to be a benefit. If the Aussie rises against those individual currencies, you would expect that to be a detriment.
So Steve's just followed on by saying, how would you recommend investors do hedge currency risk if they want to?
Well, look, if you wanted to hedge currency risk, depending on your view, you could probably look at something like AUDS, which is the BetaShares Strong Australian Dollar Fund. That is a positive Aussie dollar against the US dollar exposure of a magnified nature. That would help hedge out any US dollar currency risk, but may not assist against the currencies of other countries that those portfolios have exposure to. That said, the US is the larger geographic location for many of those indices.
There's a general couple of macroeconomic questions, Peter, around overseas equities and is it the right timing? There's one about the US market, although I will point out that obviously the funds we've been speaking about today are not US products, they're global funds, albeit they do obviously own, in some cases, reasonable amounts of US equities. Any sort of broad macro comments on investing in international equities? I'll just try and aggregate the questions into that question, really.
Oh, look, given this is a general advice session only and not taking anyone's individual circumstances into account, it is a little bit difficult for me to offer views on relative valuations and the like on various economies, unfortunately. You know, what I would go back to is that early slide showing that Australia is 2.3% of the global share market, and you know, rarely has putting all your eggs in one basket been beneficial. The benefit of all of these exposures is that they offer diversified exposure to many countries at one time.
Yep, and I'll probably just finish up with one more question, just a comment on that point. I mean, again, the important part about the funds that we've spoken about today is that they are, in all cases, very well diversified across country. So there's the quality one would have the highest weighting to the US, but in all cases there's weightings to Japan, etc. So particularly for the for the income, the quality, and the RBTZ fund, those are relatively broad exposures to a number of different markets. So you do get diversification there. So look, the final question I guess I'll just ask is about a question from Edgar around the Tigers Fund. And do you have any concerns about the possible lack of financial transparency and regulatory factors when investing in Chinese companies?
Look, yeah, again, I'm not a international trade lawyer, so I need to be measured in my comments, shall we say. But one thing that I would note is that all of the exposures within the Asia product, they're not actually listed in China. They are listed on large global exchanges outside of China. So whilst they might be a Chinese business, they need to meet the listing requirements for listing on indices such as NASDAQ or in Hong Kong or other global markets.
All right, last question from John, which is actually more of an ETF question than a global equities question. What determines buy-sell spread?
Buy-sell spread is a function of the liquidity of the underlying assets within the ETF portfolio. If I was to use two extremes of liquidity, let's take an Aussie equity ETF. That might trade on a spread of 3 to 4 basis points. If you then went out and looked at an ETF over a broad commodities basket, that might trade on a spread of 60 to 120 basis points. So the spread is determined primarily by how accessible and how liquid the underlying portfolio constituents are. The greater the liquidity, the tighter the spread you're likely to see. In all of the cases of these exposures, there is one other factor, given that they're international shares, and that are the underlying share markets that those stocks are listed on open during the Australian time zone. And in many cases, with Asian exposures or robotics, which has a tilt to Asia, etc., those exposures may be open. If not, market makers would be relying on hedging themselves with things like US market futures whilst the US market is closed. So US market futures are highly liquid. I wouldn't expect any major liquidity issues in any of these funds. And so, yeah, the spread is going to be based on the particular underlying, how liquid they are and what's open in our time zone.
Well, we'll leave it at there. Thank you very much, everyone, for your attendance and for questions. We hope you found that useful, and we will, of course, be back in the near future with more webinar material and educational material. Please feel free to get in touch with us via email, phone, or via the website for any further questions, and we look forward to being with you again in the near future. Thanks all.